Hello, everyone. So yesterday there was a comment on my YouTube video that said, hey, I joined and it didn't really work out. I was not profitable. By all means. So what I did today was I asked the group. I said, hey, guys, do you regret joining the Discord? Yes or no? I'm sure whoever typed that can understand that this is a vast majority of people. And the people who did upvote are just joking. But clearly, the vast majority of people, if not everyone that interacted with the post, is happy about the Discord. The people that are talking badly about it have never joined. And another thing that you guys need to realize is as soon as I post a YouTube video, there's people that have notifications on. And within 5 minutes, there's always dislikes on my YouTube video. So this is not out of the ordinary. So I just needed to make sure that you guys truly knew that I was not lying and that there's actually proof and good experiences that people have with this service. And I hope you guys understood that. And anyway, today we also took only 2 trades. Both of them worked out. So we are increasing the perfection that we have so far for the month. And once again, if you guys are interested in joining, the link to join is down below. I have nothing to hide. I have nothing to show that what I'm saying is not true, right? Because I'm just very transparent. So I hope this answers people's questions. Moving forward, let's get started with the video. We're going to talk about the next steps for the SP 500, the NASDAQ. A huge drop occurred at the end of the day. And we're also going to take a look at chips. AMD is starting to break below support. But other tech stocks are starting to show some strength. So we're going to take a look at all those things. And without further ado, let's get started with the video. Let's first start off with the 30-year bonds. All right, so it's important to look at the bonds because they have a correlated relationship to the market. So if the bonds are doing well, the overall market should also be doing well. What we've seen so far over the past few weeks, and we've seen that the bonds are really starting to show a lot of weakness. The yields are skyrocketing, and generally when this occurs, when the bonds are showing this much weakness, there should be weakness in the overall market. But currently, we can clearly see that the market is making new highs and it's showing strength. So there is a clear discrepancy between the bonds and equity prices. So this is definitely not a bullish sign for equities. So that very plainly, that is what's going on with the 30-year. We can take a look at the junk bonds. Also, same concept, closing below major support, not showing strength. So we have to be careful and wary about that. Moving on to the next, we quickly take a look at the dollar. The dollar is important to look at because it has an inverse relationship to the market generally. When the dollar is rising, the market should be falling. And we could also see the dollar is skyrocketing here, making new highs, closing above levels of resistance and support, etc. But this strength in the dollar is not permeating into equities. It's not causing equities to drop. This is also a bit concerning. Last but not least, the third thing that I want to show is the VIX. So the VIX is important as well because it has an inverse relationship to the market. So if the VIX is rising, then the market should be falling. But as you can see, the VIX dropped today, which caused the market to do well. So with that being said, the VIX is still holding 1850 area. If it breaks below that level, that's when things really start to become bullish on the stock market. Basically, if the VIX breaks support, then the overall market should be strong. So right now, one of the things that we were monitoring on the VIX was that it looked like it wanted to cause a MACD crossover. That is still yet to occur, but you could see this orange MACD line it's pointing straight down, which means that the momentum is lower. So what needs to happen is this faster acting blue line. We need to see some buyers step in on the VIX, to cause a price increase for this blue line to move upwards. And as the blue line moves upwards and is comfortably up, that is the way that the overall momentum on the yellow, slower MACD line is going to move up. So, from a technical standpoint, the dollar and the bonds are both showing bearishness for the market. The VIX is showing bullishness, borderline bullishness for the market, because it's doesn't look that strong currently. But this is some really, I cannot stress how rare something like this really occurs, where the bonds are just collapsing, where the dollar is skyrocketing, and we're at all-time highs, basically. So this is like very, very out of the norm. But it is what it is. We're going to take it one step at a time. This is what's fun about the stock market at the end of the day. You learn new things, and the best that you can do is make the next best decision. So with that being said, we're going to have to see what the next steps are. So now that we saw these, next I want to take a look at the large tech stocks. We're going to take a look at the chips as well. And then we're going to wrap it up, and we're going to take a look at the indices. All right, so here is a chart of Apple. And you could see that Apple was making highs yesterday. We gapped down, and then we ended up closing almost at yesterday's close. So Apple was doing pretty well. Let's take a look at Tesla. Tesla is still just chopping around in that little range, barely moving. A lot of the money is flowing into the losers. So today, Microsoft got a lot of love. It was one of the biggest losers, showing a lot of weakness. It was one of the main weak stocks, and now today it had a huge move to the upside. So money was flowing out of the winners into the losers. And Microsoft is also important. Microsoft, Google, AMD, and NVDA, as well as the other chips. But these are specifically heavily influenced by AI. So Microsoft did really well. We took a look at Tesla already. So Google is also just not doing much here. It's been the same. Amazon as well. Still doing the same. It tried to break out of this range, closed below it. Netflix, it's basically just trying to hold the new price discovery that occurred after earnings. And Meta, it bounced from the weakness, but it's still remaining below the 583.50, 584 area. So these stocks, and when you also look at the daily chart on the overall market, everything is showing signs of a bounce. So when you look at the SPY instead of the ES, you can see that it's a green candle. We are trying to show strength. The overall market is trying to show strength. NVIDIA is still trying to show strength. But then AMD started to break below the trend line, but then it regained. But overall, they're trying to show strength. That's the thing. Like, you cannot just blatantly say that this is bearish, because you can clearly see that the equities, once again, are trying to look bullish. The market makers and everything are holding up at levels of support. They're putting buying pressure on, obviously, into NVIDIA, into Microsoft, the losers, etc. So their buyers are stepping in. But it's just very, very not correlated at the moment due to the dollar, due to the bonds, what's going on with those. And it makes me very, very uncomfortable with being extremely long at this point. So, when you're looking at, the SPY for upside targets, when you're looking at the NASDAQ, when you're looking at the IWM. So the IWM is clearly has been one of the biggest losers. In the past 2-3 days, the IWM has shown a lot of weakness. The NASDAQ, however, has been holding support. And the SPY, of course, got pulled down a bit by the IWM, but it's still holding support. So We held the 580 level. We held the 577 level. We didn't even touch that today. But these are important levels on the SPY. And currently, based off of what's going on with the bonds, the VIX, and the dollar, things should be falling. The market in general should be falling. But because there's just a sheer amount of buyers coming into the market, this can easily still rip up to 590, 593, which would be the equivalent of essentially 6,000 on the ES, on the SPX. And then once again, at that point, if we go up here, so if we end up going here, right, to 593 to 600 area, up here, it would be absolutely insane to be long on the market. So that's what it is. They might rip it up. That is always a possibility. If that occurs, then all of the people that are shorting over here will feel the squeeze. Once they feel the squeeze and we end up going up, these people that were shorting here will cover their shorts and start to try to go long. And at that point, this would be the most perfect optimal situation to go to actually go short. So that's what's currently going on. The headwinds into the end of the month for earnings run up is not helping, as well as the election run up. Those are not helping the short side trade either. But it is what it is. There's just a lot of debauchery, buffoonery, inconsistencies going on under the hood, and you have to be aware of these things, especially with the dollar, the bonds, the yields. It's tough. It's a tough sort of situation. We're not really getting huge moves out of the overall market in general either, because there's just a lot of indecision. There's a lot going on in the next few weeks. We've got earnings, and more specifically, we have the elections. So let's see how everything turns out. I would love to see some abrupt movements soon, specifically in the NASDAQ and the S&P, but, that's not a guarantee. But regardless, we're going to make our money every day. We're going to be scalping. We're going to be day trading, swing trading, making the best possible decision every day, regardless. So aside from that, this is a bit interesting of a situation to be in, but regardless, we're going to take it one day at a time. So if you guys enjoyed today's video, please make sure to smash the like button, subscribe to the channel, and I will see you guys tomorrow. Have a good one. Love you guys. Take care.